To be a successful trader in the crypto market, knowing all the bullish signals isn't enough. If the market is about to turn, you need to see it coming. So here are 10 bearish crypto signals to look out for. Number 10, the bearish engulfing candle. A bearish engulfing candle is when a candle opens at or above the preceding candle's closing price and then closes below the previous candle's open. Essentially, the new candle engulfs the previous. When this occurs, it typically leads to a downside move and the asset to sell off. Number 9, the double top. The double top is a bearish reversal pattern that can be observed at the top of an uptrend and signals an impending reversal. It forms after an asset puts in 2 consecutive highs around the same level with a moderate decline in between each one. It is confirmed once the asset price falls below the level equal to the low between the 2 prior highs. And this is what it looks like in the real world. We have top 1, top 2, we have the decline in between, and then the second the price action breaks below this and this key support level, the price action sells off. Number 8, the head and shoulders pattern. The head and shoulders pattern is a specific chart formation that predicts a bullish to bearish trend reversal. The pattern appears as a baseline with 3 peaks, where the outside 2 are the closest in height and the middle one is the highest. The head and the shoulders pattern is considered one of the most reliable trend reversal patterns. It is one of several patterns that signal with varying degrees of accuracy that an upwards trend is nearing its end. And this is what it looks like in the real world. We have the left shoulder followed by the head and the right shoulder with the neckline here. And when the price action breaks through the neckline, that is confirmation that the pattern is valid. And of course, the price action will typically then sell off. Number 7, the rising wedge. A rising wedge is a chart pattern formed from 2 upwards and diagonal trend lines drawn above and below the price action of an asset, representing resistance and support. The rising wedge is also known as an ascending channel. Though rising wedges are representative of the price action being in an uptrend with a series of higher lows and higher highs, there remains a 70% chance of a move to the downside at some point, so planning a short trade around the break of the rising channel's lower support line can reap tremendous rewards if you fancy a bit of short trading. And this is what it looks like in the real world. You have the channel here, you have the support line and the resistance line, and when the support line breaks, that's typically when you can expect the price action to reverse and head downwards. Number 6, the descending triangle. A descending triangle is a bearish chart pattern categorized by a descending upper trend line and a second, flatter horizontal support line. A descending triangle is commonly considered a bearish chart pattern or a continuation pattern within a downtrend. The horizontal line represents support that initially prevents the security from declining lower. Imagine a large buy order placed on this level and it takes a number of weeks or months to fill. Eventually the lower support line breaks and that's your signal to short. Or if you're thinking of buying the asset, it's your signal to wait before entering. And this is what it looks like in the real world. We have our diagonal line here forming the triangle and we have this support level. And then finally, when the buyers get exhausted and sellers take control, we then have the sell-off and the price continues lower. If you're willing to put in the time to get to know this market and develop your skills, you can achieve percentage gains like these. I will be routinely breaking down successful trades and highlighting my decision-making process for each one. No hot air or bluster here, just the cool breeze of a strategy that works. If this content is for you, please consider subscribing. Number 5, bearish divergence. Bearish divergence, regular and hidden, provide bearish signals that help identify potential trend reversals in the price action of an asset. It involves comparing the price action with an oscillator such as the Relative Strength Index or the MACD, and occurs when the asset's price and the oscillator move in opposite directions, signaling a trend reversal is likely. Divergence is one of the more challenging indications to spot, but it's as close to having a crystal ball as you can get. And this is what it looks like in the real world. We have the oscillator putting in a lower high, but the asset itself putting in a higher high, creating a divergence in the trend between the two. And typically that will lead to downside. Number 4, the breakdown of the 200 MA. Moving averages provide an array of helpful signals to traders, with the 200 MA particularly useful given that traders use it predominantly as a line in the sand when assessing the overall trend of an asset. Automated trading bots are also programmed to buy and sell on the break of the 200 MA. Therefore, when the price action of any given asset crosses below the 200 MA, as it does here, represented here with this yellow line, that can provide an excellent indication that the price action is likely to continue lower. So if you're thinking of entering a long trade, but the price action has just crossed below the 200 MA, you may want to hold off as lower prices are likely ahead. Number 3, the top of the fixed range volume profile. The fixed range volume profile indicator calculates the volume data within a specified period of time, allowing traders to analyze the volume activity of an asset across a specified range, as seen here. The fixed range volume profile provides clear potential reversal points for the price action based on the extremes of recent activity. Therefore, when an asset's price action approaches the upper range, as you can see here, or a low volume node, the likelihood of a reversal increases, providing a helpful bearish signal to investors looking to take profits or to open a short trade. Number 2, an overbought RSI. The Relative Strength Index, the RSI, provides clear signals for when an asset is either oversold, bullish, or overbought, bearish. The RSI oscillates between 0 and 100 and is considered overbought when above 70. It can serve as a simple yet effective indication that the price action is likely to reverse and begin selling off soon. Used in conjunction with other bearish indicators, it can be a helpful tool to assess when to take profits when in a long trade or when to open a short trade, should you be one of the bears. And this is what it looks like in the real world. Here we have on the RSI overbought conditions above 70, and as you can see following that, the price action of the asset begins to decline and sell off. And finally, number 1, the bearish retest. A bearish retest is a confirmation signal that indicates to traders that a key trend line has been flipped from support to resistance, suggesting more downside for an asset is likely. The bearish retest can be used as final confirmation following the breakdown of a pattern or trend line that the price action is highly likely to head lower. And even though some traders will open short trades or exit their long positions based on the very first sign of a bearish break below key support, as you can see here, the bearish retest affords the price action the chance to reverse back into the pattern first or back above key support following the breakdown before traders choose to react. But if the price action can't successfully recover, as it doesn't here, and gets stuck below previous support, that signals to traders it's now appropriate to exit their long positions or enter a short trade. Here is what the retest looks like when paired with some of the other bearish signals and patterns we've looked at today. This is the double top we were previously looking at, defined by these 2 peaks here, and this is our key support line. And when that support line breaks, the price action comes back up to perform a bearish retest. This is where you would enter for a short trade, or this is where you would exit your long trade if you're looking for confirmation that the uptrend is over. Next up, this is the descending triangle we were looking at earlier, which has got this key support line and these declining peaks which form this diagonal upper trend line, the triangle essentially. And once the price action breaks down below the key support line, you'll notice again that it most likely will come back up to confirm that this level has flipped from support to resistance, and this would be your entrance for a short trade. And finally, returning to the head and shoulders pattern we were looking at earlier, defined by the left shoulder, the right shoulder and the head, a very powerful bearish reversal pattern. When the price action does finally break this support line, break the head and shoulders neckline, the price action is likely to come down but then quickly come back up to confirm that this previous support line is now resistance. And in doing so, that forms the bearish retest. And as long as the price action doesn't come back up above previous support, that is confirmation that the price action is likely to head lower, which is an excellent place to exit your long position if you've been riding the price action up, or if you're thinking of entering a short trade. That's it for now. This has been 10 bearish crypto signals. If you like the content I provide, don't forget to hit the subscribe button. We also have a trading group you can join. Links in the description. Catch you in the next one.